Hey guys, this is Mrs. Schoenberg, and this is our chapter 13 and 14 combined lecture. I'm going to do this in two parts. Chapter 13 is finally we're getting to that fourth financial statement, which is the statement of cash flows. There's a couple different methods that I have to teach you on how to do that. And chapter 14 is all about financial statement analysis. So there's a bunch of different ratios and things like that that you'll calculate for me. So, getting started here, the statement of cash flows reports cash receipts and cash payments by three types of activities. And those activities are operating, operating. The second is investing. Third type of activity is financing. So, cash flows from operating activities reports the cash inflows and outflows from a company's day-to-day operations. Day-to-day. These examples include cash receipts from customers, any bills that are paid that are relate exactly to the business. Okay, when you write checks and you pay a bill, and it, you have to keep your electricity on, those type of things, just regular type of cash inflow and outflow. So when we're starting to talk about investing activities, if a company had cash coming in, that's related to a company's long-term assets. Long-term assets. Some examples of this are cash receipt. Let's say you sale of equipment. You did a cash sale of your equipment, brought in some cash. That would go in the investing activities section. And then finally, cash flows from the financing activities are related to changes in a company's long-term liabilities, perhaps even stockholders' equity. So investing and financing for business may be affected by transactions that do not involve cash. If you're dealing with something like that, they're going to be reported in a separate schedule that accompanies the statement of cash flows. Because when you're looking at the statement of cash flows, you're really talking about cash inflow and outflow. Now, I guess one thing I wanted to make here, if you did a payment of dividends, for example, a cash payment of dividends, that would be the example for cash outflow for a stockholders' equity type transaction. Here's a really nice thing I took right out of the textbook. It talks about cash inflows and cash outflows, and it gives examples like what's operating inflow, what's an operating cash outflow, and then same thing with investing, inflow and outflow, and same thing with financing. Okay. So here are the two different ways to do a cash statement of cash. One is the direct method, and the second is the indirect method. So the direct method reports operating cash inflows, the money coming in, receipts, and cash outflows, money payment, as follows. So basically, you take any cash received from customers, subtract cash paid for merchandise, subtract cash payments for operating expenses, subtract cash payments for any interest payments, subtract cash that you did pay for income taxes, and then you get this net cash flow. It's kind of like balancing your checkbook, the checkbook of your business. Now, switching to the indirect method, it's a little more indirect way of getting to the cash. But it starts by, you start with net income. Net income. And you adjust that net income number for revenues, expenses that do not involve the receipt of cash or payment of cash. It gets a little confusing because you're sort of doing the opposite. You're subtracting and adding things, and sometimes you think you should be adding and subtracting those things because you're starting at net income and then taking out things that did not involve cash. Anyway, primary advantage of this indirect method is that it reconciles reconciles the differences between net income and net cash flows. And the data is very available. So the indirect method is less costly. So as a result, you're going to see the indirect method a little more commonly used. So let's jump into homework 1306. This is going to help you. This is the indirect method. And remember, with indirect, we start with net income. In this case, it's $404,000. Depreciation is going to be important. It's $109,000. Depreciation is not a cash inflow or outflow. Balances of the current asset and current liability accounts at the beginning and the end of each year follows. Okay, so this is important. This is what it was at the end of the year. This is what it was at the beginning of the year. Okay, and again, this was non-cash. We're going to be adding that number back. Okay, now we want to take a look at the difference here. So first of all, look at the difference in our cash. We have to reconcile that. So for the accounts receivable, the difference is it started out beginning of the year at 88, it went down to 82. That's a difference of $6,000. Inventories went up by 4,000. Prepaid expenses went down by 500 from the beginning to the end of the year. AP, this is how much money was owed to merchandise creditors. It started out 115. They actually paid that down quite a bit. So it went down by 22,000. And then their salaries payable went up. So they paid less in salaries, if you will. It went up by $1,600. Okay. So we're going to prepare the cash flows from operating activities section, just that section of the statement of cash flows using the indirect method. We're going to use the minus sign to indicate cash outflows, cash payments, decreases in cash, or any negative adjustments. Okay, again, this is a partial statement of cash flows. This is cash flows from operating activities. We start with net income. Net income, we're going to come over here and make that amount be $404,000. Adjustments to reconcile the cash flow. We had depreciation, and we're going to add $109,000 back because that was an expense that had nothing to do with cash, so we need to add it back. Changes in current operating assets, liabilities. That's where we take those numbers we just looked at above, and we're going to write them here. There was a decrease in accounts receivable. That is going to be plus 6,000. Why? Because if you think about it, if there was a decrease, so that means customer paid in more money. Customers paid in more money. There was an increase in inventories. So you used your cash and you bought more inventory. Okay, so that's actually a minus there. There's a decrease in prepaid expenses. That's a plus 500. There's a decrease in accounts payable. Decrease in AP. 22,000 actually. And a decrease in accounts payable is going to be a decrease here because you paid that liability down pretty far. 22,000 more. And then finally, there was an increase in salaries payable. So you didn't pay as much as what you had at the beginning of the year. So that is a positive 1,600. Draw the line. And then we're going to, the label here is net cash flow from operating activities. Net cash flow from operating activities. And you would put this 404 in your calculator, 404,000 plus 109,000 plus your 6,000 minus 4,000, so on and so forth. And for this example, you would get 495,100. So when you get to this problem in your homework 13.6, kind of follow along, use this as a pattern. It should help you out. Next one, homework 13.19. This is a cash flows from operating activities direct method. Okay, so last one was the indirect. This one is the direct. And you tell me which one you like a little better. The cash flows from operating activities are reported by the direct method on the statement of cash flows. And here's what we're going to determine. A, if sales for the current year were $854,500, accounts receivable decreased by $58,400. So you got in more money from the customers. What was the amount of cash received from customers? Believe it or not, you can find that out by what's been given. Here it is. If the sales were 854,500 sales for the year, plus we're going to add to that the decrease of AR because customers sent in that money, right? So we're going to add to that 58,400. Adding those two numbers together, 912,900. That is the cash received from customers. So it's not only the sales amount, it's any decrease in the AR from the beginning to the end of the year, cash received from customers. And then number two, if income tax expense for the current year was $45,600 and income tax payable decreased by $4,500, so you paid in more income taxes because the payable decreased. So in this case, you would add those two numbers together. You would take your $45,600 income tax expense, and then you would have to tack on to that plus your $4,500. And what you did is the amount of cash payments for income taxes was $50,600. Oh, $50,100. There we go. Okay, so use that as a guide on 13.19. There's a part 2 of this lecture. Come back and watch it because it's going to deal with the bigger problems in chapter 13. So switching on over to chapter 14, it's all about ratios, and it talks about basically taking those financial statements. You get this information, but you got to use it to make economic decisions. So financial statement users typically evaluate this information along 3 dimensions. Liquidity, how liquid is the business? How quickly can they convert cash? How much cash do they have on hand? Solvency, how can they pay their bills? Are they meeting the amount of their bills? And if something happens, can they continue to do that? And also, how profitable is this business? Profitability. So 2 common techniques are used to analyze a company's financial performance and condition. Analytical methods, known as horizontal and vertical analysis, and also these ratios that I've been talking about. Both analytical methods and the ratios, they are used to compare a company's financial performance over time or to another company. So the analysis of the relationship of each component in a financial statement to a significant total, that one is your vertical analysis. We'll do an example of each. And then your horizontal analysis is when you take, it's sort of the analysis of percentage increase and decrease in related to items in comparative financial statements. Okay, then there are all these liquidity ratios. Here's some examples of the liquidity ratios. Then we also have solvency, and there are some solvency ratios. And then finally, we have our profitability ratios. And then I really want you to notice here, when you start getting into problem 14.04a, please, you're going to want to use this little helpful hint. I have gone through each one of these and kind of told you, hey, number 1 is asking for working capital. So subtract your current liabilities from your current assets. It can be a very difficult problem, but if you have this little helpful hints, please have it handy. I'm going to tell you the math you need to do. Now, some of them are percentages, and when you get to a percentage, you need to always remember to take that times 100. But and also there's a clue because there's a little percentage sign on the answer. But this should really help you get through your chapter 14. So that's what I have for now. Come back and listen to part 2.